Greetings class and welcome back. This is the video over chapter 5, determining inventory. And in this video I'm going to talk about chapter 5 material that we will have here in the book and some things that we'll be considering as we go through this chapter. In this video I'm going to reach back some to chapter 4 because these two interconnect very closely. So when we think about chapter 4, we were talking about dealing with a merchandising business, and we were talking about how we connect a merchandising business with a service business and how we compare those. And they're very different, but the big difference is going to come in the merchandise inventory that we account for as a part of a merchandising enterprise. So in this case, what we're going to consider, at least in chapter 4, was how do we record those entries in the journal and how do we close those accounts at the end of the accounting period and how do we report them. So in this chapter we're going to be focused more on what we include in inventory and how we actually value the inventory. So the first item that we need to talk about is what do we include in inventory. And essentially, as a merchandising business, probably everything you have in the store, or most of it, will be things that you purchase in inventory and goods that are available for sale. Now, these goods will be counted in your inventory if you own them. That's the big question. Do you actually own them? And so the question that we're going to ask to determine whether goods actually belong in this inventory or not is whether you actually own them yet or not. So when we talk about goods in transit here, we're going to talk about where, how those goods are shipped. If goods are shipped FOB shipping point, that means we're paying for the shipping costs or the freight. We're going to receive the title and the ownership to those goods the moment they are placed in transit, the moment they are shipped from the seller. So as soon as they are placed on the truck, the train, or whatever they're using to ship them, we are going to record those in our inventory. Now, if they ship the goods FOB destination, meaning that the seller is paying for the freight, then the seller will continue to count those in their inventory until such time as we receive them in our possession. So we will not count them in our inventory until we receive them in our possession, and that's the big difference here. Goods on consignment. If we are a consignment shop, these are not particularly common, but they do occur with many boutiques. But you may have some goods that are placed in the store on consignment. The consignor, the person that brings the goods in, that person is the owner of the goods, and they will maintain whatever they have given to you to sell, or whatever the merchandiser is selling. The consignor that brings the goods in will continue to claim those in their inventory. The person that owns the merchandising business and is actually doing the physical selling of those items will not record them as their own because they don't own them. So this will not be in the inventory of the shop or the merchandiser. This will be in the inventory of the actual consignor. Now, if goods get damaged or become obsolete, it depends on what we're dealing with there. If they're damaged goods, we may be able to sell them at a reduced price, and that might still have some value, but we want to recognize the net realizable value. So we may have to discount those heavily in order to sell those. If goods become obsolete or out of date in some way, those are goods that we're not able to sell anymore, and we don't want to report those in inventory. So if something is out of date or no good, we would not be able to sell them. And the example here, the best example, is if we have perishable items that we're selling and they go past the expiration date, we can no longer sell those, so we need to discard them and write them off. They would be, as they go bad and we discard them, they would be losses or reductions in the inventory value. So those are the things that we include and don't include in inventory. Now, one of the things that we need to do, if we run a perpetual system or if we run a periodic system, it doesn't matter. We need to take a physical count of inventory once a year. So, in order to prevent fraud, and this is an issue for auditors, they want to make sure that the count is actually a good physical count of the inventory that is actually in the merchandising business. In order to make this as structured as possible and place what they call internal controls in place to ensure the validity of the steps, we'll use typically pre-numbered inventory forms that are distributed to counters, or now they'll probably do this electronically, but they're going to limit who gets what. They're going to know who has been assigned to count specific things. They will be assigned, and they won't include people who are actually taking care of the inventory. So if there's a warehouse manager, that person is not actually going to do the inventory. It'll be somebody else. Counters are going to go through the inventory, merchandise inventory in the store or warehouse or wherever it is, and they're going to determine its validity, whether it exists, how much is there, what kind of condition it's in, and then there will be a second count. So you won't just do one count. You'll have two counters go through and verify the same amount exists in the count. And then a manager will oversee that and confirm the count for the whole thing. Now, if we talk about inventory costing, we're going to talk about how do we figure out what the value of the inventory is. What kind of cost are we assigning to it? Now, many times this can depend on the type of business that we operate. We have 4 different kinds of inventory valuation that we're going to talk about. Specific identification, first in, first out, last in, first out, and weighted average. Now, they're shown here how often these are used. You can see FIFO is a very popular approach. LIFO is also fairly popular. Weighted average is a big one, and then the other slice is very small, and probably that's going to be because if you're a merchandiser, there's not going to be a lot of people who are dealing with specific identification, because specific identification will be used when you have large ticket items and you have items that can be specifically identified and are unique. This would be true of somebody who, a merchandiser like a jewelry store, who has high ticket items in the store, or somebody who runs maybe an auto dealership or some other kind of large ticket sales where you have items with serial numbers. So inventory cost flow assumptions. We went over this in class, but I want to restate this because it is so important. With FIFO, first in, first out, the costs are going to be, cost of goods sold are going to be lower. The inventory will be higher, and your net profit will be higher. So FIFO, assuming that costs are going up as time goes by, and they typically do, this means that the cost of goods will be based on the earliest items purchased, so your costs will be lower, your gross profit will be higher, and the inventory itself will be higher as well. Now, this is what may represent the actual flow of goods in a business, but LIFO is also used, and this is used sometimes because businesses may see the tax advantages of using this. And the tax advantage is that you have a higher cost of goods sold, so you have lower gross profit. And with lower gross profit, you'll have a lower cost of income tax. But inventory will be valued a little bit lower too. So you'll have lower gross profit, lower inventory, but cost of goods sold will reflect what the current cost of items are. And sometimes this is the approach that the business wants to take. This will be the lowest cost inventory, ending inventory, and the lowest gross profit. Then when you get to weighted average, this is right between FIFO and LIFO. And it's going to be a calculated weighted average for all the goods purchased so that you'll have essentially a gross profit that will come right between what you would get with FIFO and LIFO, and the same thing for inventory costs. So we'll talk about how to calculate these in just a moment. But FIFO is assuming that the first things you received are the first things you sell. Typically, this is the case. You're not necessarily going to sell the last thing you receive before you sell older stock. Typically, you rotate stock in a merchandising business so that the older goods are sold out. Now, LIFO assumes the cost flow is in the absolute reverse order of FIFO, that the unit you most recently purchased is the unit you're going to sell first. What this does, really what it does, FIFO is going to keep track of the cost of these items based on probably the way you're going to sell the goods. LIFO will match up the most current cost of goods that you're getting into the store so that you're actually going to have a more current cost of goods than you would with FIFO. However, it depends on the election that's being made by the business owner. And then the weighted average just assumes that you're going to average all of this stuff together. You're going to take all the units you purchased divided by the total, or you're going to take the total cost of all the units you purchased and divide that by the total units purchased. And when you do that, you're going to get a weighted average cost, and then you're going to calculate based on how many units you have in ending inventory what you actually have. Okay, so they show here, this sort of illustrates what we're doing. We're actually trying to figure out what these costs are going to be in order to report the ending inventory and cost of goods sold, that we'll know exactly what value should be placed in those. So here's an illustration of inventory costing, and we went through this on the PowerPoint, but I want to spend a little bit of time here with it because I think it'll be helpful. So to start with, when we purchase anything, we're buying them at cost, and here's what we're doing. We have beginning inventory, we have these purchases, we have these purchases, and these, and you notice the price is constantly changing. That's not far removed from the way things happen. So we have a total purchased units of 55 units, and the total cost that we've incurred for these items is $5,990. As we sell these goods, we have a couple of choices to make. We can actually specifically identify what it is we're selling and say, well, these are the prices that we're the cost that we incurred for these, or we can use some kind of a FIFO or LIFO approach. But here is the retail price we're going to sell the goods for. So when we go here, we have 20 units that we sold at $130 each. And this is going to be what was left in our ending inventory. So we started with 10 units. We added 15. We have 25. We sold these 20 units, and the retail value was $130. And we have 5 units left. Then we come in and purchase 20 more units, so we're up to 25. Buy 10 more units, we're up to 35. And then we sell 23 units at $150. That's the retail price that we charge for those. And so we end up with 12 units in ending inventory. We know the retail value of these items, but what we need to determine is how we're going to compute the actual cost that we're going to assign to those goods that we just sold. So if we were using specific identification, it would look something like this. In this case, we have the total units available, 55, and a total cost of $5,990. And we are selling on August the 14th 20 items. And what they're telling you in this is that they're selling 8 items that are $91 each, and 12 items that are $106 each. And they show you that here in these parentheses. So they're selling 8 items that cost $91 and 12 items that cost $106 on August the 14th. The retail sales price for these was different. This is the cost that we paid for those. So we're going to take that $2,000 because we're taking 8 times 91 plus 12 times 106. We add those together, we get $2,000. Then on August the 31st, we sold 23 units. And again, this is specific identification. And we're going to say, okay, well, now we kept track of this and we sold 2 of the units, 2 of the remaining units that we paid $91 for, 3 units that we paid $106 for, the 3 remaining units, 15 units that we paid $115 for. So when we go through this, we're selling these, the rest of these, and the rest of these. And then we get to 3 units that we're selling at 119. So we add up the cost for each of these. So we're taking 2 times 91 plus 3 times 106 plus 15 times 115 plus 3 times 119 to get 2,582. Our total cost of goods sold then under specific identification is 4,582, giving us an ending inventory of 1,408. So the cost of goods sold will be 4,582 and ending inventory will be 1,408 if we use the specific identification approach. Now, if we use a different approach, that number will change. So here is the assumption based on a first in, first out approach. We start with the 55 units, 5,990. Using a FIFO approach, we're going to assume that the first units that we purchased were the first units that we sold. But with FIFO, we're going to work backwards. We're not going to actually calculate cost of goods sold. We're going to back into the number by working from the bottom up and calculating where we draw our ending inventory from. So this is kind of the opposite of specific identification. With specific identification, we're going to identify the cost of goods that we sold and then back into ending inventory. But with first in, first out, we're going to identify where that ending inventory is going to come from, which purchases, and we're going to identify that cost, and then we're going to calculate from that the cost of goods sold. So we know we have 12 units in ending inventory because if you go back to the initial problem up here, the running inventory total was 12 units. So if we have 12 units in inventory, we want to think about where we're actually going to draw those from. If we are practicing a first items purchased, first items sold practice, that means that the remaining 12 units will have to come from these 2 layers of inventory because all these others have been sold. So we're going to work backwards to calculate what those are because on first in, first out, the cost of goods sold is associated with these earlier purchases. Here, you're going to take the 10 units at $119, and then you'll have 2 units at $115 to get the cost or to get the ending inventory. So we'll go down here to the FIFO approach, and this is what they do. 10 units from the August 28th purchase at $119 each, and you calculate that, 1,190. 2 units from the August 17th purchase at $115 for $230. Your total ending inventory then is $1,420. Last in, first out assumes that the last items you purchased are the first items you sold. So with this, instead of going from the bottom up, you're going to start from the top down to calculate ending inventory. So with LIFO, you're going to go back up here to this model. And LIFO assumes that the last items you purchased are the first items you sold. So it's going to assume that your purchases came from these items here, from this layer of inventory on August the 28th, August the 17th, August the 3rd, and whatever remains is going to be the beginning inventory and a part of what's in this purchase on August the 3rd. So with 12 units remaining, and you're using LIFO, last in, first out, you're assuming all these other layers you've sold some items out of. So when you go in here, you're going to basically calculate the ending inventory from the first two layers that you purchased items in inventory. So your first two purchases. 10 units are going to be in ending inventory from the beginning inventory at $91 each for $910. 2 units will come from the August 3rd purchase at $106 each for $212. This means with LIFO, your actual ending inventory will be valued at $1,122, and that will be subtracted from the total cost of goods purchased to arrive at the cost of goods sold of $4,868. So that's what we have in the cost if we're using LIFO. With weighted average cost, what you're going to do is you're just going to take all the purchases, 55 units, all these purchases, add them up, and then add up the cost, $5,990, and take the $5,990 divided by 55 units to get an average cost, a weighted average cost of $108.91 a unit. Once you do that, then you're going to go back in when you figure out you have ending inventory, and you're going to calculate the ending inventory cost. You're going to take 12 units at $108.91, because you're saying, okay, this is my ending inventory cost per unit. That times the 12 units, you get $1,307. The cost of the 55 units that are available for sale are what you're going to have to start with. That's this total, $5,990. Once you calculate ending inventory, you subtract that out, you get cost of goods sold, and then you have your value of ending inventory and cost of goods sold on the weighted average approach. Okay, when you look at the financial statement effects of these different costing methods, what you'll notice is that the specific identification is going to be an exact method. And it's going to be an exact method because you're tracking exactly what you purchase and exactly what you sell, because you can specifically identify each product. Now, if you're using a large volume merchandiser, you can't do this. It's just too time consuming. So instead of using specific identification, you're going to use one of the other three methods. So if you're a high volume merchandiser like Walmart or Meijer or somebody like that, you're going to use one of these other methods, and you're going to calculate based on the ending inventory dollar or inventory units and where you take those from in your purchases. So notice, specific identification is exact. They have a net income here and an inventory cost here. That's exactly based on the value of the items that they're tracking. If you couldn't track those, you would go perhaps FIFO, and here you'd have a slightly higher net income than you would with specific identification, and a slightly higher ending inventory cost. Now in this case, you're going to have a lower cost of goods sold number slightly with FIFO. But the difference will really show up when you compare FIFO and LIFO. LIFO is going to have a higher cost of goods sold, and it will be apparent, and have a lower net income, that will also be apparent, and have a lower ending inventory, which will also be apparent. Now, if you're looking for the middle of the road approach, that's the weighted average, because you'll notice that the weighted average cost of goods sold comes right between FIFO and LIFO, and the net income is right between FIFO and LIFO, as well as the ending inventory. It's right between FIFO and LIFO. So it's sort of a middle of the road approach. Now, if your costs are regularly rising, what's going to happen is this scenario that I just pointed out here is going to be what you see. In a period when rising costs are going on, you're going to yield the highest gross profit and net income with FIFO, and you'll yield the lowest gross profit and net income with LIFO. But if for some reason costs start to fall, it's going to work the opposite way. With FIFO, you will approximate current cost for inventory, but if the costs are falling, you'll have a reverse order. FIFO net income, if costs are falling and you're using first in, first out, it'll look like a lot more like LIFO in this example because you'll have a lower net income. When we talk about the cost of inventory and how it looks on the balance sheet, when you're looking at FIFO and you're actually, if your merchandising business conforms to FIFO and the flow of goods, that's going to reflect the most current cost for your inventory and the actual flow of goods for your business. But LIFO, instead of doing that, it will show you a cost of goods sold that is approximately what the current costs are, and it will, in terms of matching current costs with revenues, it will be more, it will match current costs with revenues a little better. Weighted average will smooth out any erratic changes, so I mean, it's just like I said, a middle of the road. And then a specific identification is going to be an exact approach. When you get into tax considerations, basically you have to elect a specific approach, and whatever approach you use for the IRS is also the approach you have to use in your business. You cannot use, for example, you cannot use LIFO for taxes and FIFO on your income statement. You have to use them both. You have to use LIFO for both. So if you have a tax advantage with LIFO, you can use it, but you also have to use it in your business to account for your merchandise. The one thing that we didn't talk about in class, and we're going to continue to talk about this in class when we meet again, but is valuing inventory at lower of cost or market, and then what might happen if you have an inventory error. So the lower of cost or market basically means when you do your inventory valuation, there is the possibility that the market may have changed for your goods. And if it has, you'll want to look at what is out in the market and compare it to what you have in inventory. So when you look at this, they've got some inventory items here: Roadster and Sprint, 20 units and 10. Cost here is $8,500. Cost here is $5,000. For Roadster, the market value per unit is at $7,000. For Sprint, it's $6,000. So the total cost, if you're going to take the 20 units times the cost per unit of $8,500, is $170,000. And then here you're going to take the cost of 10 units times $5,000 for $50. Now, when you're going to look at lower of cost or market, what you're going to do is you're going to look at it like they do here. You calculate the market value. So you would take 7,000 times 20 units. That's 140,000. And then here you would take $6,000 per unit times 10, you get 60,000. So what you're going to do is individually compare the lower of cost or market. So in terms of lower of cost or market, if the market value is higher, we do not adjust up. But if the market value is lower, we will adjust down. In this case, the total cost that we have is $170,000, but the market value is $140,000. So we need to make an adjustment in our inventory valuation to drop the value of the Roadster model down to $140,000. of that inventory. For the Sprint version, there's no need for an adjustment because market value is higher than the cost, so we're not going to mark it up. Now, this is because of the conservatism principle in accounting. We will always understate it rather than overstate it. So if we're going to record what happened or what we're looking at for what we just did to adjust the value of inventory, when we reduce the value of inventory because of the market, we're going to increase cost of goods sold, because what we're actually doing is we're saying that we're moving the cost of those items out of ending inventory and into cost of goods sold. We still have the items. They're still sellable. They are still good. They are not outdated, but the value of them has declined. So we're going to recognize the additional cost in cost of goods sold here and decrease our inventory value by the amount that we're over the market value. That's the $30,000. So that's an example of adjusting inventory for lower of cost or market. Now, when you talk about the financial statement effects, if you misstate inventory in one year, it comes out in subsequent years as well. So, for example, if ending inventory is understated, cost of goods sold, because they're complementary of each other, cost of goods sold and ending inventory, if ending inventory is understated, cost of goods sold will be overstated, and that means net income will be understated. That's in the first year. If, on the other hand, ending inventory is overstated, then that means cost of goods sold will be understated or too low, and that means net income will be overstated or too high, and that's the first year. Now, going into the second year, you'll see a reversal of what happened in the first year. So with this over and understatement in the first year, what's going to happen in year two is it will reverse itself, because you have this understated ending inventory. You're now going to move into the new year, and you're going to have an understated cost of goods sold, because the inventory you're starting with is already understated. The cost of goods sold will be understated, and the net income will come out overstated in year two. Now, if you start out in year one with an overstated ending inventory, because cost of goods sold comes from that ending inventory, your cost of goods sold in year two is going to be overstated or too high, and net income will be too low or understated. So it's kind of important to think about how those things will impact not just the current year, but subsequent years as well. And you can see that flow through this chart here. So you have the effect of these errors on 3 periods. Okay. And with that, I'm going to conclude this video on Chapter 5. I think we've covered the primary topic areas for inventory, calculating value. When we meet again, we'll be going over more of this, and we'll be heading into our next chapter and getting ready to prep for or think about the next exam that we have coming up. Anyway, I hope you have a great weekend, and take care.